going to review some construction accounting foundations within the firm and how we do things here. And specifically today, we're going to be talking about items and how they differ from accounts and how we should be entering some transactions. So the learning objectives of this video is a real quick introduction of why construction accounting is different, contractor concerns and why items matter, difference of structure and purpose of job costed and general expenses, item and account mapping hierarchy, how and why we use items in BEAA, how sub-items flow to items, accounts, and financial statements, job profitability detail report, which is the item level reporting, and then profit and loss by job, which is the account level reporting. So we're going to be reviewing what the standards of the firm are and what the process and procedure and why we do things a certain way. So I always like to teach. I always like to teach not just the how, but also the why, so everyone can not only understand what is in front of you, but consistently looking down the field to understand the importance of why you need to pass the ball a certain way over to the reviewer and just kind of all the way to the top. The better job a preparer does, the rest of the chain is going to be that much more efficient. And that's the goal of the firm, to be as efficient as possible to solve the client's problems. The more efficient we are, the better product we make, the more money we make, and the more opportunity the firm can provide to all our employees. All right, so traditional compliance-based accounting. Most compliance-based clients only care if the financials are prepped for the tax return. These are low-value clients that we want to make sure we are the most efficient as possible. Most businesses ask one question, if they even ask: did we make money? Revenue minus expenses equals net income. They may have some confusion because a lot of these clients think that any money going out is an expense, such as a loan, and sometimes may have negative cash flows because they are repaying loans, which does not reduce net income, rather reduces the loan balance. Do not spend too much time on these clients. So as of this moment in the summer of 2026, we have a lot of our clients have been compliance based. We had our book that was just kind of through brute force to make the accounting firm be able to have some gross revenue so we can sustain enough activities to now build towards the future. And a big shift of the firm to be able to provide construction accounting services to contractors. The goal is we're going to probably have compliance-based clients for a while, and they'll be phased out progressively over time. However, we do expect to have them. So these type of clients, we're just going to be entering their expenses straight into accounts. We don't even have to worry about items or anything because these clients are just strictly motivated by compliance. All right, so contractors ask a different question, or actually different questions. Contractors need historical information to make sure they are bidding jobs accurately. They ask, did this project make money? How much did I spend on concrete labor? How much did I spend on materials for doors? How much did I spend on surveys? This is why we need to pay special attention to the way we classify expenses. So contractors, really what they're going to be caring about, and the higher, or rather the larger the company, the more detailed that item level accounting needs to be. And you're going to be using quantities and units of measurements as the drivers for those. However, a lot of the SMBs, which are the small and medium-sized businesses, they're going to be using a lot simpler estimates that a lot of the times you can get away without being so granular as to how many blocks of concrete you bought, as opposed you can probably just get away with doing lump sum quantities. If we're going to go look at analysis on per square footage, or the projects are so small, we can just kind of pop into the invoice and it's really only one, 2 or 3 invoices, right? I don't have to go too crazy in the accounting. That helps us reduce cost for the contractor, make the engagement efficient, and make the analytics efficient for them. Most of the time on these smaller projects, these guys are going to be analyzing what their cost per square footage. They might just ask, how much did we spend on concrete? And they're going to take a look at the total square footage of the house. Ideally, we do want clients to be on quantity and unit of measurement, and that's always going to be the preferred method. There won't always operate that way, so we have to kind of finesse our way into creating a happy medium. All right, accounts versus items. Chart of accounts equals financial reporting. Items equals operational reporting. Accounts tell you where money went. Items tell you what the money purchased and give us more reporting dimensions. Before I jump into that, important details on items. All sub-items are mapped to cost of goods sold account. All parent items map to construction income. Example mapping. Interior paint, the parent item, mapped to construction income. So if we tag an item to the parent interior painting, in an invoice, it's going to get the construction income. But if we do it to a bill, it's going to debit construction income. So we need to make sure we identify on when we're using an item to say, okay, it's interior painting and what, and the sub items are not only mapped to a cost of goods sold account, but the sub items themselves are named after the cost of goods sold account that they're being mapped to. So it's pretty easy, right? You're going to have interior painting, purchase materials, subcontractor, salaries and wages. We'll review these hierarchies more in depth in a later slide. And right now, I just kind of want you to understand when you're mapping things to accounts, you're going to be using financial reports that show you analysis at the account level. Contractors are always going to care about operational reporting way more than the account level reporting or financial reporting, right? And the driver of these operational reporting is items, right? I'm going to look at my profit and loss by, job profitability detail. Why? Because it's going to tell me more information about my operations. It's going to show me how much I've spent on subcontractors, purchase material, salaries and wages for shell, right? All right, so here's the mapping hierarchy. We've got sub-items, interior doors, purchase materials. The parent item is interior doors in this case. The account is purchase materials. That's where this is being mapped to. And then it's being routed to financial statement, the profit and loss, right? In this case, because it's a cost of goods sold. So that's going to show in your profit and loss under the purchase materials account. Important note, when the parent item is selected only, it flows to the financial statement as construction income, since that is the mapping for the parent items. We only use the parent account hierarchy when creating invoices. When entering bills for expenses, we will use sub-item level. So in this case, if we were going to create an invoice to bill a client for this, you would just eliminate basically this part of the hierarchy. It would just be parent item and the account would be construction income here. And then it would flow through your profit and loss on your top line. Construction accounting adds more dimensions. Traditional or compliance-based clients. Transaction goes straight to an account, so it goes to your chart of accounts, which flows to your financial statements. Done. Construction accounting. Transaction goes to sub-item that lives under an app to an account, and then reflected on financial statements. And also now you have the operational reporting to show your reports by item. And on top of that, now the transaction needs to be tagged to a customer job to ensure accurate job costing. Now, every single transaction that is an item is always going to be job costed. So that means that it needs to have a customer and job in that line in QuickBooks. If not, it's never going to exist, and that's policy of the firm, where we're never going to have an item that's not job costed. The only exception may be if we decide to use items, which we'll see an example later, for general expenses to condense the profit and loss, and specifically accounts relating to general and administrative, which are not going to be affecting cost of goods sold. And those things will be mapped straight to a general and administrative expense. However, anything else, any other item expense, basically triggers a red flag, needs to be job costed. So now this is going to add dimensions to this, right? We can see account level reporting by job, right? So profit and loss by job. We can see operational level reporting by job as well. We can see operational reporting of the entire organization, right? This explanation is going to show why I love using the correct quantity and unit of measurements. For example, I wanted to know how many blocks were purchased in the entire company, and that's going to give me an idea of, I can either look at it as linear foot of wall, or I can either look at it as square footage. And then I can look at my productivity of the salaries and wages for masonry in relation to that, and start to kind of come up with a burn rate, knowing that I can buy X amount of block and that's like their maximum production monthly. Or is that, start to ask better questions, is that your maximum production monthly? And you can really start to get good insights on this type of operational reporting and the different dimensions that you can use. And we'll look at some examples later in a later slide. All right, job costing. Every transaction should answer who was paid, what was purchased, which job, what item. Outputs: job profitability detail, profit and loss by job, budget versus actual. Pretty self-explanatory. We explained this kind of already up to this point. We're going to see some examples on how to actually do this in QuickBooks. All right, these are popular construction KPIs, financial KPIs, gross profit, net income, cash flow. Pretty self-explanatory, and I think basically all clients have the same KPI at some point, right? Everyone's going to try to look at net income. Operational KPIs: job profitability, labor percentage, material percentage, budget versus actual. These are going to be driven by operational reports, job profitability detail, any report that is item based. Strategic KPIs: backlog, WIP, revenue per PM, bid accuracy. That's a little bit more complicated scope, and we'll review it in future videos, but for now I really want to focus on this operational KPI. And then you have the other equally important, I'd say 99% encompasses these two types of KPIs, right? Operational KPIs, job KPIs. You're going to spend most of your time here. And eventually, why items matter. Without proper item mapping, the job profitability detail report will not be accurate. As a result, many of the key performance indicators contractors rely on to make bidding decisions will also be inaccurate. This can lead to underpricing jobs, overstating profitability, and making poor business decisions. Items are operational reporting categories. They will allow us to track costs at a level of detail that is meaningful for job costing while keeping the financial statements clean and easy to analyze. So here's an example of be accurate. As a result, many of the key performance indicators contractors rely on to make big bidding decisions will also be inaccurate. This can lead to underpricing jobs, overstating profitability, and making poor business decisions. Items are operational reporting categories. They allow us to track costs at a level of detail that is meaningful for job costing while keeping the financial statements clean and easy to analyze. So here you can see a example of job profitability detail for a job. And you can see here some purchase materials, subcontractor payments. Here's very simple client, and their estimates and items are pretty broad. Not projects aren't very big, so it's just enough for his analysis, and he likes to see things this way. But you still have a lot more visibility as to what is going on, right? And this was like 50 something parent categories. This is just a small section of the job profitability detail. So how the BEAA structure works. When creating items, we need to be conscious of two things. How is this making my financials more concise, and how is this helping operational reporting? So as I mentioned before, there is very few times that we'll use items mapped to general and administrative expenses, which is the non-job costed transactions. Instead of creating separate general ledger accounts for every payroll tax expense, we can create individual items for Social Security, Medicare, FUTA, SUTA. I actually had discussed this situation with Pedro over the weekend, which is one of the reasons why I wanted to create this video, so we can understand how and why we use items at the firm. So in this case, for construction clients, I don't want the chart accounts or the profit and loss to be very expansive on certain items that are not going to be beneficial for analysis for construction, right? We need to think of, when we're preparing financial statements, that is the part of a CEO's dashboard that is going to show him a high bird's eye view of what the financial status of the company is, right? So the more concise a financial statement, we don't need it to be 20 pages long. We don't need 4 accounts that for something that can be said in one. For his analysis, FICA, Medicare, FUTA, SUTA is not going to change. Lump them on payroll taxes, one item. If we need to see them broken out individually, we'll use item level recording. As accountants, there's still an additional dimension that we can use in case that we need to use it to prepare quarterly reports for whatever reason, or if it's easier to tie out, or for year end, certain things may be easier for us to keep track of, right? So we always need to be conscious of how we need to be doing things so that the client, aka CEO most of the times of the company, can easily see a concise profit and loss, and that's going to tell him exactly what he needs, and balancing it with how do we make this so we can also have max utilization from the accounting side, right? And normally the dimensions that items add is a very convenient dimension for us to take advantage of, have concise financial reporting. So each of these items maps to the same payroll tax expense account. In this example, we'll see a hierarchy of how that works. On the profit and loss statement, each of these items maps on the same payroll tax expense account on the profit and loss statement. This gives us detailed operational reporting without cluttering the chart of accounts. A concise chart of accounts is essential. As contractors grow, they naturally accumulate more administrative expenses: vehicles, equipment, technology, insurance, marketing, payroll, and office expenses. If every operational category becomes its own general ledger account instead of being tracked through items, the profit and loss statement can quickly grow to 20 pages or more. So this is an important thing. When I bring a client to the firm, it is not about having the client that is going to stay there where they currently are. It's about looking at where the client's going to be in 5 to 10 years. I am not trying to bring construction clients that are going to be stuck in revenue at $500,000 for 10 years, right? That is going to be a compliance-based client. I will not be a construction client. So when we are looking at a client, we also got to think, if I make 4 payroll accounts, and then I'm going to bring in eventually shop, because they're, for example, the example we spoke about over the weekend was Hyperion Electric. So I've got 4 more payroll accounts. Then maybe I'm going to bring in employee benefits and stuff in about a year or 2. I'm going to have 4 more accounts. And at the same time, I'm buying 3 bucket trucks and I've got a maintenance contract. So now I've got an entire shop category and I'm going to have another 10 accounts between what's now being added to. I've got like 30 accounts on just 2 small portions. And we haven't even talked about sales, marketing, and accounting. And once they bring in an internal accounting team, software expenses, I mean, these things are going to start to grow on them, right? And at the end of the day, your G&A starts to become the majority of your profit and loss, but the biggest drivers of construction is cost of goods sold, right? So you're just creating a lot of noise. And we need to be very conscious that we're not preparing financial statements for ourselves. We're preparing financial statements for the clients to be able to interpret. Oh, let's see what's going on here. This keeps going nuts. All right, so this is an example hierarchy. You can see sub-item level, payroll item, right? This is for the example that an expense is going to be general and administrative. So you have the sub-item level being mapped to the item level. So payroll items is the parent item, and then that is being mapped to payroll expense, right? So all of those accounts being mapped to payroll expense. As you can see here on the picture on the right, I went ahead and highlighted all the payroll related items. But the one that we're going to pay attention to in this case is going to be the last one, the last highlight, where it says payroll taxes. So you can see I've got my FICA, my Medicare, my FUTA, my SUTA mapped to payroll expenses. So when I'm looking at my profit and loss very cleanly, I can go ahead and see, okay, cool, we've paid X amount in payroll taxes without seeing everything broken out. And if we wanted to take a look at this broken out, we would just run a report by item under a specific job, or run the report by the actual item across the entire company to get what we're looking for. By job, let's correct that, because actually in this case, these are G&A expenses. These are not job costs. The way that we apply these to a job later is to a labor burden adjustment, which we'll discuss in a later date in a whole different slide or PowerPoint. So at BEAA, our basic item hierarchy for job costed transactions is based on a method where sub items are named and mapped to COGS accounts, and parent items are mapped to construction income. When we have an expense or vendor credit, we map to the sub item to make sure that it will affect the correct expense account. When we are invoicing a client, we will utilize the parent account. So the sub item actually has the same name as the cost of goods sold that it is being mapped to. The only thing is that that sub item is living under the parent item. So we may have salaries and wages for people doing interior doors. We may have salaries and wages for people doing shell. We may have salaries and wages for people doing landscaping. And we want to define when they're doing their timesheets and they're bringing it over to us and we're processing payroll and we're entering into the system, that we are applying the correct expense of their gross wage to each one of these items, so that the contractor later has visibility to see how much payroll was expensed on a certain task, right? So in this case, the sub items you can see here go straight mapped to the cost of goods sold for whichever one is relevant. And then the parent item, so we're creating an invoice. I'm not going to invoice the client for each purchase material, salaries, and wages. At the most detailed level, I would be invoicing the client. In interior doors, I'm billing you X amount as per the contract, right? Some contractors might not even want to get that specific. They're going to show an invoice with all the descriptions and then just one total on the bottom, which is possible in QuickBooks also, and will be discussed in a later video. But most of the time what we do is we just bill off of the parent item, and that's the most detail a client will ever see. So now here's an expense example. In this bill, we see the sub-item purchase materials under the drywall framing parent account. This means that the total of this line item will appear under the purchase materials COGS account in the profit and loss. So in this first one, you see, okay, we've got a screen cap from a bill. We've got drywall framing purchase materials. So we got purchase materials as the sub-items. You can tell that is separated by this colon. And then drywall framing is the parent account. This is being mapped to purchase materials. So when we see where this number is flowing through, it's going to flow into the profit and loss under cost of goods sold into the purchase materials account. It's that number is within this total here, right? Because obviously there's a lot of other expenses in that time period. Now, when we go to tagging something straight to the parent account, as is in the example of the invoice down here, this invoice, we see the drywall framing parent item. This means that the total of this line item will appear in the construction income account in the PL. So we're invoicing just to the parent account. So that parent account, whatever the total is going to flow through this construction income on the profit and loss, right? You can see down here, cost of goods sold, where it lives right under construction, or right out of your total income. And where that, previous transaction was flowing through, and you can see where this parent account is now flowing through here. All right, so this is just an example of the operational reporting. So job profitability detail report is probably one that's used the most, and we showed an example in earlier slide. So you can see here, your actual cost, actual revenue, what your difference is. This is different than a budget versus actual report. This is just telling you what was costed and what was billed, right? And then this information, we actually use it for our work in progress adjustment, which we'll discuss later. Now, another dimension, which is at the account level that we mentioned before, profit and loss by job. So now you're seeing in the account level, each one of these columns is a different job. So you only have visibility of accounts, not items in these reports, to have a little bit of a different dimension on how we want to be analyzing the progress of certain jobs. So key takeaways. Items drive operational reporting. Items help maintain concise financial reports. As we saw, this is mostly applicable to general and administrative expenses such as payroll, whenever we choose to use them, which is not very often. All job costed expenses use items. There is no exception for job costed expenses. Anything that's a job costed expense, which means it flows to cost of goods sold, requires an item, no exceptions. Not all general expenses require items. That's correct. We only use them when we want to create a more concise profit and loss. But if we have a Google software renewal and we're normally tagged that client to software expense, and we don't really need an item to make it go to software expense. It's not job costed, it's general administrative expense, tag it straight there. And when we have the example of payroll, or when we get into clients that have a more complicated shop because they have a massive fleet now, we're going to see ourselves using items for general administrative. However, general administrative, it does not exclusively use items, unlike job costed expenses that do. General expenses can use items for more concise financial statements, as we just described. Sub-items are mapped to cost of goods sold accounts. This is not an exception for job costed items. All sub-items for job costed items, such as shell purchase material, interior doors purchase material, landscaping salaries and wages, they are all mapped to an account that lives in cost of goods sold. No exceptions. Job costed expense goes to cost of goods sold. Parent items are mapped to construction income. So every time we have a parent item like we saw before, map straight to construction income, pretty self-explanatory. All right, so that's the end of our analysis on how BEAA approaches items in construction accounting and what our procedure is. We appreciate you investing your time in becoming a better construction accounting professional. Our mission is simple: to reduce uncertainty by delivering confidence through exceptional relationships, technical excellence, and relentless follow-through. If you found this training valuable, write a review for more free construction accounting education, practical QuickBooks instruction, and real-world insights from the field. Here you have information on the firm, and here's a little piece on our firm values. So thank you guys, and see you in the next video.